All right, here we go. And now we're going to start Unit 4D. We're going to talk about loan payments, credit cards, and mortgages. So let's do this. Okay, so here are the basics. So the principal, and we've heard this term before. So it's the amount of money owed at a particular time. So when we're talking about investments, the principal was the amount of money deposited or the lump sum that was invested that is accruing interest. Similarly, with loans, the principal is the amount that you're owed, or excuse me, that the amount of money that you owe at any particular time. An installment loan, or what we call an amortized loan, is a loan that is paid off with equal regular payments. Okay, so equal regular payments is the key. So any kind of loan that is structured this way or amortized is an installment loan. So there are different types of loans that you're familiar with that are installment loans. Your car loan, your mortgage, those are types of installment loans. The loan term is the time you have to pay back the loan in full. Okay, so that's the term of the loan. So now, here is the payment formula for installment loans. Okay, so it looks similar to the payment for an investment, right? So for an annuity, right? But it's in this case, it's a little different because we're talking about paying down a loan instead of making regular deposits into an interest-bearing account. Okay, so again, so this formula here is the formula we use for calculating the payment amount for an installment loan. Okay, so a lot of the stuff is the same as we've seen before. So payment is PMT, P is the starting loan principal, and the APR is the rate, right? The percentage rate, and it's an annual percentage rate, and is the number of payment periods per year. So that's a little different now, and has a slightly different definition, right? Before, when we were talking about annuities, N was the number of deposits per year. Here, this is the number of payments per year, since we're talking about paying off an installment loan. And then, of course, the Y is the length of time that what the loan term is. Okay, how many years it will take to pay down the loan, or that you plan on paying down the loan. Okay, so now principal and interest for installment loans. So there's two portions, right? So the portion of installment loan payments going towards principal, and the amount that's going toward the interest rate will vary as the loan is paid down. So your payment amount stays the same, but the way the proportion of that payment that goes towards interest changes, okay, over time. So in the beginning, very little is going towards principal, okay? And then as you pay down the loan, the more and more of the higher and higher proportion of your payment will go to principal, okay? As opposed to just going towards interest. And this is what we mean by amortized, being an amortized loan. Now, this is what I just said. Okay, so early in the term, the portion going towards interest is relatively high, and the proportion going towards principal is relatively low. And of course, as the loan proceeds and you pay more and you're getting closer and closer to paying off the loan, the amount going towards interest decreases and the proportion going towards principal gradually increases. Okay, so here's an example. Okay, suppose you have a student loan totaling $7,500. When you graduate college, the interest rate is 9%, and the loan term is 10 years. What are your monthly payments? How much will you pay over the lifetime of the loan? What is the total interest that you'll pay on the loan? So these are three good questions that we want to answer. Okay, So first of all, we need to figure out what our loan payment is, and that's where that loan formula, the payment formula comes in. So we've got Y, we've got the APR, we've got the principal, right, which is $7,500. We also know that we're making monthly payments, so we know N is 12. Okay, so we've got everything we need to plug in. So let's do that. Okay, so here's our formula. We'll plug in the values that we know. Okay. And now we simplify in our calculator and we find that our monthly payment is going to be $95.01. Okay. So now that means over the course of 10 years, I'm going to make monthly payments of $95.01. And so that's 12 months a year. So that's going to be 120 payments. So if I take 120 payments times $95.01, that's going to be $11,401.20. That's the total of my payments. Okay. So now, what was the principal amount though? The principal amount was $7,500, which means if I subtract that from the $11,401.20, then I get approximately $3,900 that represents the interest that I paid. Okay. So yeah, that's the answer. All right, cool. Okay, now let's look at the first 3 months. And this is how we look at the way it's amortized. Okay, so it's very similar to the way we were looking at compound interest. Okay, so when we look at an amortization table, it will look something like this. Okay, so the first month we take 0.0075. Why 0.0075? Because we're taking monthly payments. So it's going to be, the interest is compounded monthly. So we've got to take the 9 and divide by 12. Okay. And so we get 0.0075. Okay. So if you take 9% and divide by 12, that's what you should get. Or 0.09, I should say. Okay. So now if I take 0.0075 times the $7,500 loan that I have, my interest amount is $56.25. Okay. That means of the $95.01, right? So this is the payment. That means $56.25 of that payment is going towards interest, and $38.76 is going towards principal. And that means that my loan amount decreased by $38.76. So at the end of the first month, when I make my payment, now my principal balance has decreased a little bit to $7,461.24. So that's what my new balance is going to be. Now here's where they have a typo. These are incorrect, because now the 7461 is my new balance, 7461.24. And of course, my new amount, so this is wrong. So these are typos. So it's going to be $55.96. And this is going to be $55.67. So for month 2, I take 0.0075 times the new balance of my principal, and the interest went down slightly to $55.96. Okay, so it went down by almost 30 cents. So now I subtract that $55.96 from my payment amount, which is again $95.01. And so now the new amount that's going towards principal is a little higher. So now I'm going to subtract $39.05 from my balance, my previous balance of $74.61.24. And now my new principal balance is $7,422.19. And then of course, month 3, the same thing happens. Okay. And so this is the way how you pay down in an installment loan. This is the way it works. And of course, there's all kinds of software that we can use that does this really easy. Excel, you can find many Excel templates out there for amortized loans, amortization tables. So it's really easy to find. Okay, credit cards. Credit cards are not installment loans. Okay, you are not required to pay off your balance in any set period of time with a credit card. Okay, so these would not fall under the definition of an installment loan. A monthly payment is required. Monthly payment generally covers all the interest, but very little principal. In fact, if you have a credit card and you just pay the minimum balance, or excuse me, the minimum payment each month, it will take you a long time to pay off your balance. Okay, so just be aware of that. Okay, so here's an example. So let's say you have a $2,300 balance on your credit card with an annual interest rate of 21%, and you decide, hey, I'm going to pay this balance off in a year. Okay, so I'm going to pay it off over the next year. How much will you need to pay each month? Okay, so what are your monthly payments going to be? Assume you are going to make no further credit card purchases. Okay, so now basically what you're doing here with this credit card is you're treating it like an installment loan. Okay, so you have a balance of $2,300. The interest rate is 21%. You're going to pay it off in 1 year, and you're going to make 12 monthly payments, and you're not going to use the credit card at all. Okay, so we're going to use, in this case, we're going to use the installment, the payment formula for installment loans, because that's the way we're treating it. Okay, so our monthly payment would have to be $214.16 to pay it off in 12 months. Okay, so basically $215 a month. Okay. Okay, let's talk about mortgages. Okay, so mortgages is a specific type of installment loan designed for financing a home. Okay, so mortgages are specific to buying a home. Okay. So let's see. The interesting thing about mortgages, if you look up the origin of the word mortgage, it actually comes from 2 Greek words that means death grip. And it actually has its origin in serfdom, when you would have to work on a land for a certain number of years as an indentured servant until your debt was paid. And so that's where this idea of a mortgage comes from. Okay. So anyway, the down payment is the amount of money that you are going to have to pay up front in order to be given a mortgage or other loan. Okay. Usually it's 20%. 20% is the standard. In fact, that's what's recommended. Closing costs are fees that you have to pay in order to be given a loan. So these are all kinds of different things. So they could be direct fees, which is basically the cost of an appraisal or doing a credit check. Fees that are charged as points. Okay, so these are percentage points, which are percentages based on the loan amount. So for example, an origination fee or a discount point if you want to pay a point to get a lower interest rate. Okay, so these are what we call points. Okay, and these points are what are charged based on what the loan amount is. Now, there are 2 types of mortgages. There are fixed rate mortgages, which means that the interest rate is guaranteed to not change over the life of the loan, hence fixed. And then there's also an adjustable rate mortgage, or what we call ARMs. Okay. This is one where the rate is adjustable, where it goes up and down. It changes from year to year. Okay. Some of these have a fixed period. Some of them don't. Okay. So let's look at closing costs, and let's look at the Great Bank and Big Bank. Okay. So let's say Great Bank offers a $100,000 mortgage, 30-year mortgage, 5% fixed, and with the closing costs of $500 plus 1 point. Okay. Big Bank offers a lower interest rate, so instead of 5%, it's offering 4.75% on the same loan, 30-year loan. But Great Bank's closing costs are $1,000 plus 2 points. Okay. And evaluate the two options. So we're going to look at the two options and decide which one is the better option. Okay. So is it better to pay the higher interest rate or the lower interest rate with the higher closing costs? Okay. Let's evaluate. Okay. So again, what we're going to want to do is figure out what our payment amount is going to be for each option. Okay, so for Great Bank, our payment amount is going to be $536.82. Okay, let's look at Big Bank. So for our Big Bank, our payment is going to be $521.65. Okay, so the payment is lower. Okay, so 536 versus 82. Now, so it is a lower interest rate, or excuse me, a lower monthly payment. So now what we have to do is we have to look at the closing costs. We're paying more money. We're getting a lower payment, but we're paying more money in closing costs. So the question is based on how much more money I'm paying on closing costs, how long will it take me to break even or recoup the money that I'm paying up front, given that I'm getting a slightly lower monthly payment? So now we're going to have to look at the closing costs and look at how much I'm saving per month and see if it's worth it. Okay, so now you're going to save about $15 per month with the Big Bank's lower interest rate. Great. Okay, so now we're going to consider the difference in closing costs. Now, Big Bank is charging an extra $500 plus 1 point. And again, 1 point is on the value of the mortgage. Okay. Which is going to be $1,000 because it's a $100,000 mortgage. Okay. So now that's going to be $1,500 up front. Okay. And so, let's see here. Okay. So, because we're paying an extra point. That's right. We're paying an extra point. So we're actually paying an extra $1,500 in closing costs. So now we got to figure out, okay, how long will it take to break even or get our money back for the $1,500 extra dollars we're paying? Okay. So we're saving $15 per month, but we're paying an extra $1,500. So how long is it going to take to recoup that money with the savings? So let's do it. So it's just a simple division. So $1,500 divided by $15 per month, and that's going to be 100 months, which is 8.5 years. Okay, but it's a 30-year mortgage. So I'll make my money back in 8.5 years. So I'm definitely going to save money on going with Big Bank's lower interest rate. So that's the way you figure it out. So here's an example of the way a loan is amortized. Okay, so this is an example of a graph showing how the payments are divided. Okay, and the percentages. I like this because you have the two secondary axes here, right? So this axis here is the payment, right? So notice that the payment doesn't change, right? It's $537 a month. But notice how this portion is going towards principal. And as you can see, as you go along the graph, more and more of your payment goes towards principal. And this axis over here is showing what percentage of your payment is going towards principal. Okay, so you can see that it grows. See, here's the thing. Notice at the 15-year mark, right? Notice at the 15-year mark, you haven't even paid, you're not even at the halfway mark. Okay. So the key, now here's the thing, here's where I'm going to just, my personal opinion and advice is pay off your loan early. The quicker you pay off your home, the more money you save. In fact, typically you're going to spend 2 to 3 times more than your loan on the value of the house. So if you have a $100,000 loan, you're going to spend $200 to $300 when it's all said and done if you just make the payments for the next 30 years. Okay. The thing about mortgages is even if you have a 30-year mortgage, if you pay it off in 15 years, it would be like you paid the amount of interest on just a 15-year mortgage. Okay. So just if you make an extra payment, that goes a long way. An extra payment a year goes a long way to pay down your mortgage quickly. Okay? All right, rate approximation for ARMs. Okay, so here's where we're going to talk about the adjustable rate mortgage. So we have an ARM, and we're going to do a choice between a 30-year fixed rate at 4% and an ARM with the first year at 3%, neglecting compounding and changes in principal. Estimate your monthly savings with the ARM during the first year on a $100,000 loan. Suppose that the ARM rate rises to 5% by the third year. Okay. How will this affect your payments? Okay, this is important. So this is good example. Okay, since mortgage payments are mostly interest in the early years of the loan, we can make the approximations by assuming that the principal remains unchanged. Okay, which is not a bad assumption, or simplification. For the 4% fixed rate loan, the interest on the $100,000 loan is going to be approximately $4,000. Okay, so you just take 4% of 100,000, so that's going to be your first year interest. With the 3% ARM, your first year interest is going to be $3,000. So right away you saved $1,000 the first year going with the ARM. Okay, now, so looking at this, if we divide that by 12, that's approximately $83 a month savings. Okay, that's the monthly savings. But let's look at this a little closer. Okay. Well, what happens with the rate? The rate after the first year is going to go up to 5%, right, by the third year, which means it's going up approximately 1 percentage point a year. So if it's 3% the first year, it's going to be 4% the second year, and so that means the third year it's going to be 5%. So we can assume that it's going up 1% a year. So that means the second year we're breaking even. And then the third year, right, we're breaking even because the rate is 4%, which is the same as the other loan. And then the third year, we're now losing $83 a month. Okay, so all the savings that we got the first year, we're losing, we've pretty much given that money back the third year. Okay. And then, of course, if the ARM keeps changing, it could go down, but likely it's going to go up. it's going to cost us a lot more money with higher payments than the fixed loan. Even though the fixed loan is, we're paying a higher interest rate, fixed interest rate, and the ARM is lower in the beginning, but it won't stay that way. All right, and that is the end of this section. And you guys have a great day, and I will see you next time.